Hi there, everyone, and welcome to Allica Bank's next market briefing. This is the series where we try and give you, as accountants, some really useful content and insight from a day-to-day bank, just to give you an insight as to what we're seeing in the market and hopefully some useful information you can pass on to your clients. Today, I'm really pleased to be joined by Gareth Anderson, who is Allica Bank's Head of Business Management. Hi, Gareth.
Hi, Matt. How are you doing?
Yeah, really good, thank you. Just before we kick into the topic that we're here to discuss today, which I'll introduce shortly, do you mind giving everyone a little bit of background as to who you are?
I certainly can. So, Gareth Anderson, as you so well introduced me, the Head of Business Management here at Allica. Head of Business Management is a very fancy title for someone who gets involved in lots of things. No, so I wear a number of hats at Allica. The most important one being that I currently lead our current account outreach teams. So the guys and gals that go out there talking to customers around our current account proposition and crucially how we help SMEs to make their money go further.
Lovely, thank you very much, Gareth. And you've got numerous years, I mean that in a complimentary way, of experience in banking as well, haven't you?
Too many. Somebody actually said to me recently, which I was slightly offended by, you and I remember the mortgage crash of the 90s. And I did explain that I was about 5 years old then, and I wasn't talking about the mortgage crisis on my way to primary school. But yes, 16, 17 years in banking.
Well, no, thank you so much, Gareth, for joining me today. And as you said, one of the big things you're responsible for here is our current account proposition, and that's part of what we're here to talk about today, which is around the current account market and how I tried to eloquently frame up, how can businesses make their money work harder for them. So I guess the first thing to sort of go through is, do you mind giving us a little bit of a potted history of the current account market at present? Obviously we hear stories all the time from accountants and introducers around challenges with clients getting current accounts during that period. So do you mind kicking off with that? Is that okay?
Yeah, absolutely. So, I think that the first thing to say is the market is very different now to where it was even a few years ago. Base rate at 5% is, for a lot of people, terrifying. And, when we have had interest rates as low for as long as we have, understandably, it's coming as a shock to the system to see interest rates as high as they are today. The reality is, if you go back to pre-financial crisis, it was pretty normal for interest rates to hover around the sort of 4-5% mark. And if you go back to the late 80s, early 90s, they were as high at one point as 14-15%. So what that's meant for savers is there hasn't really been a market. Borrowing has been very cheap, but if you were a business with excess liquidity, surplus cash, the chances of you getting a good interest rate on those savings was pretty slim pickings, and certainly that was the case for current accounts. And of course we've had COVID, and so what COVID has done operationally for the banks is placed them under huge strain and challenge as a direct result of having provided huge amounts of government-backed lending to support businesses through lockdowns and all the challenging times that were wrought by the pandemic. There's an interesting statistic which still blows my mind, which is 10 years worth of lending was done by the banks in 1 year during COVID.
I do have to, just on that point, I mean, you've got to take your hat off, in spite of the criticism, and let's be fair, they have been criticised. In spite of all that criticism, they did do an amazing job to get that sum of money out of the door into the economy. It's just, however, now we are dealing with the challenges that come along with that, aren't we?
Yeah, you're absolutely right. I often refer to the banks as being the good guys during this. It's not often you can refer to the banks as the good guys, but they absolutely were. I mean, they stood up technology within the space of months that might ordinarily have taken them years to stand up. They got business lending to businesses that needed it pretty quickly. But what it meant from a current account perspective was that as the banks re-geared their operations to support lending, they were repurposing their teams. And so people that once might have worked in KYC functions, so know your customer functions, working in customer due diligence functions, essentially anything to do with opening and onboarding new customers, opening up new accounts, those roles became repurposed for government lending. And what that led to was the start of what has increasingly become a real challenge for businesses and accountants. You will all have experienced this in some way, shape or form, which is it's getting harder and harder for a business owner to open up a bank account. We hear horror stories of 6 weeks, 8 weeks, 20 weeks, and sometimes that's just to open up an existing account for a business that's already banking with that particular bank.
Yeah, like you said, 6 to 8 weeks has definitely become the norm. I guess if we think about the market, then you sort of touched on it a minute ago around the interest rate changes, but as an accountant, knowing where to turn to when you need a current account is a challenge, but there's so many different things to consider. No longer is it just about a current account; it's about the features that are attached to it. It's about security. Criminals, fraudsters have become ever more, I guess, modern in how they approach things, and therefore security's got to be key. Integration with accounting softwares is key, probably for a current account, in my opinion. How do you decide where to look at to get that current account open?
Yeah,
Or what do you think are the crucial factors?
Yeah, I mean, just picking up on your point on fraud. If there was one industry to invest in right now, it's fraud. It is the fastest growing industry in the world. And of course, I mean that tongue in cheek, because it is absolutely terrifying. And the banks have a huge role to play globally in trying to combat the risks of financial crime and helping to keep people's money safe. What would I look at, though, or what would I want to look at as an accountant advising my clients? Well, there's probably for me 3 or 4 things. The first is about convenience. How quickly can somebody support opening up an account for me? We're all very aware that SME owners make plans quickly, and once they make plans, they want to execute them quickly. The last thing they want is being held up by, quite frankly, what should be seen as an inalienable right, which is just having a basic bank account. If you are looking to trade with a new customer and you want a bank account to support that, and you're told it's going to take 6 to 8 weeks, understandably that's going to be a cause for real frustration. So convenience would be one. The second is about who you are working with. Now, every business owner has different interpretations as to what they want from their bank and how they see a relationship. Certainly many clients that we speak to at the moment really like the idea that every client that opens up a current account with Allica Bank has a dedicated relationship manager and a point of contact. That's important. Why? Because running a business is an incredibly lonely place. There are always challenges, there are always headwinds, there are always things to be grappled with. And sometimes just knowing that you have somebody, your bank, who you can pick the phone up to and say, hey, listen, could you guide me through this a little bit? Or I'm stuck here and I'm grappling with this problem. Just having that person to talk to, having that support there is hugely important. And, we should be clear, there are a lot of banks right now that are retrenching from relationship management models. And the reason being is and arguably understandably, it's one of cost. Where do you best serve a small medium enterprise? They're perhaps too big and too sophisticated in terms of needs to be supported within a retail bank, and arguably, and certainly in the eyes of the bank, they'd be too small to be supported within the corporate bank. So they sort of fall between the cracks, and so banks will often try and offer a sort of a telephone-based service. But actually getting hold of people's never easy, and when you do get through to somebody, you're usually not through to the right person. So now we are pretty clear and priding ourselves on the named point of contact. And I think the third thing, and the thing that's pretty obvious right now, is the interest rate that's paid. We are all, in a very challenging time, and so if you're a business owner, anything that you can do to make your money work that little bit harder for you needs to be considered. And I just would say it's okay to work with multiple banks. There is this misconception, and it's one that's been around for a while, that a customer works with their bank and only their bank. We know that switching is challenging. We know that very few businesses actually feel the confidence to go away and move banking providers. But we've got to start to be more comfortable and confident to go and look around, because there are some great banks and great challengers providing some really compelling products and propositions. It's just that a little bit of time needs to be taken to go and seek them out.
I think what's really interesting in this current economic climate that we're in at the moment of, high levels of inflation, costs to businesses are rising through, light and heat. We've got interest rate at, record levels for the last 15 or so years, which has both a positive and a negative effect. If you're a borrower, the costs in your business have increased. If you're fortunate to be in a cash rich position, what can you do to make your cash work harder? In my experience, businesses almost need, very few SMEs would have a treasury management policy, but they almost need that to think, what is the minimum amount of cash that I need to hold for everyday use?
Yeah.
What is the minimum amount I need to hold in a rainy day pot that I can gain relatively easy access to? And what is surplus that I won't need for 6-12 months? Because, as you said, that there are so many products out there at the moment, from fixed rates to notice accounts, that, grant you higher rates of interest. And, I guess this is almost my next question to you, is there's lots of press coverage at the moment, isn't there, around the rates that that businesses and savers are getting. Are you able to provide any sort of comments around that?
I mean, I think most of our audience will have seen that the banks got frog marched politely into number 11 last Friday to have a discussion with the Chancellor about what more could be done to both ensure that the mortgage time bomb, which is ticking and increasingly ticking, doesn't go off, and when it does go off, that there's the right support in place to help people, but also, and crucially, that rates of savings are being passed on to customers. Banks make money through, really simple terms, what's called net interest margin. And that is basically the difference between the interest that they pay to savers and the interest that they earn on lending that they charge to provide finance to borrowers. The difference is the net interest margin. Over the last 12 months, as interest rates have risen, what we've seen is banks benefiting from increases to the interest rates on their variable rate lending. There's the pup there. And what that's meant is that they have enjoyed the benefit of seeing rate rises on their lending, but they have been very slow to pass on rate rises to savers. Now we should, caution here, because they have moved on savings rates. So something like a 12-month fixed term deposit, the interest that you would get on a 12-month fixed deposit in average terms is a lot higher than where it was 12 months ago. They have moved on notice accounts, they've moved on fixed term savings products. But where they haven't moved is on current accounts. And the reason banks would point to not having moved upon current accounts is because, the business of banking is a relatively complex one. You need to ensure that you maintain certain levels of liquidity to fund your lending originations, to ensure that you are able to support businesses seeking to withdraw their funding at any given time. So banks will pay more for funding that is locked away. Why? Because it gives them stability and certainty. With instant access, they will always view the risk of these funds could be withdrawn at any given time, which of course is absolutely true. So they would make the argument that, because it could be withdrawn at any time, there is a greater risk attached to us potentially having to scramble around for liquidity. So we will not pay as much as we perhaps could or should. Now, what's interesting is challenger banks are challenging that tried and tested theory. How are they able to do that? Because they've got much lower costs than banks. They're not carrying or laboured by the huge branch networks, the infrastructure costs. So actually what that means is that they can pay higher amounts for instant access savings. And if you look at it in simple terms, if base rate is currently at 5%, a bank could, in theory, take that money of its depositors, drop it within the Bank of England reserve account, and be earning 5%. So the argument is always, well, why can't you pass on some of those rate rises to your customers for instant access? And we are starting to see more banks doing that, but it's going to be a relatively slow and protracted process. I think it will gradually start to accelerate as banks come under more political pressure. They start to see a greater need for deposits as their credit books come under greater stress, but it's certainly not going to happen overnight.
Thank you, Gareth. Like you said, it's a really interesting market at the moment. It's one of the big things we get asked about all the time is, what can you do for clients in order to, support them from a liquidity point of view? And, I know it's something that we're really proud of at the moment. So, like I said, it's definitely a hot topic on people's minds because more so than ever, like I said, over the last 15 years, making sure your cash works for you and isn't losing in real terms is really important.
Yeah, I couldn't agree with you more, Matt. And I think, the days of accepting that there aren't options out there for savings and surplus cash, they're gone now. As accountants, you guys need to embrace the options that are out there and proactively work with your clients to guide them down those paths. It might be something as simple as a business that's saving money for their VAT. Or rather than just having that money sitting in a current account for 3 months earning nothing, put it into an embedded savings wallet with a bank like Allica, where it might earn you something or would earn you something. And so it's being comfortable and confident to shop around and to embrace the fact that it is a saver's market now. And there is no real excuse for not making businesses' cash work that little bit harder for them.
And like I said, it can make such a huge difference. Like I said, if you're in that fortunate position that you are cash rich, the difference between 0.1 and 3% that we're currently offering can be substantial. So for every, I think it's for every £1 million, it's an additional £29,000 of interest income over the course of a 12-month period. Which is a substantial sum of money, like I said, in this market. It's an extra member of staff, new kit for the business, which is in that business's back pocket. Definitely something I think that...
I do like your thoughts about SMEs having a treasurer in their pocket, because I do think that as we navigate through the uncertainty and the challenges that today's environment bring, there is a need to think a little bit more strategically about how you manage your liquidity. And it extends beyond just, well, what are the payment terms that I offer to my customers, and how do I manage the payment terms to my suppliers? Yes, of course, the focus on cash is always going to be the most paramount thing that any business can do. And we all know that for a lot of SMEs, they carry usually only as much as about 3 weeks to a month's cash at any given time. So, we're under no illusions of the pressure people are under. But actually taking a step back sometimes and saying, even if I'm just doing small things, like ensuring that if I'm saving for VAT or for a piece of capital expenditure, I make sure that I'm getting the best for my money for the period in which I'm saving it for.
Well, look, Gareth, thank you so much. I think, like you said, those marginal gains in this tough market are really important. And I think there's some really interesting takeaways there around, diversifying your cash holding, how you think about it working harder for you. but also considering your options in terms of you don't just have to be with one bank. There's lots of things to consider. It probably is really key you have accounting integration on your main current account for your accountants and your advisors' ease, but possibly looking at broader options for your cash holding, your VAT, to allow you to earn that little bit extra income, because there are plenty of options out there in the market. It's just
Yeah.
having the time to go away and do
Yeah,
it.
you're spot on. And I would just say one final thing, which is, we talk to a lot of businesses that say, I don't want to switch my current account. And we say, well, that's absolutely fine. You don't need to. And there's this look of almost shock. So what are you trying to do then if you don't want my current account? Actually, you can go away and work with another bank and keep your current account with your existing provider. Understandably, there might be too many barriers or too much cost or perceived friction to make a full switch. But there's absolutely nothing stopping you from working with a bank to help you with your savings or your surplus cash. And sometimes I think it takes reframing the way we look at this problem, because it absolutely, as I said earlier, is a savers market now.
Lovely. Thank you very much for joining me today, Gareth. Like I said, hopefully some really useful takeaways for people there. If anyone does want to reach out to us, please feel free to contact us on LinkedIn or visiting the Allica Bank website, where you can contact your local relationship manager to discuss things in more detail. Join us next time for more interesting comments on the current banking market. And if there's anything you want us to discuss and give you that little bit of insight in, please make sure you add your comments below.